Hey guys, my name is Jonathan Reich. I'm a licensed CPA in the state of Louisiana, and as a licensed CPA, I help small businesses deal with all kinds of things. Everything from getting ready to sell your business, to getting it off the ground, to dealing with the day-to-day transactions, strategy, tax, softwares, everything that is business encompassing, I kind of find myself touching. And I want to welcome everyone here to The Digital Merchant. This channel is about digital marketing, online businesses, how to get intelligent growth, and today we're going to break down something that I think is important, which is you're getting ready to sell your business. How do I get it ready? How do I get the most money that I can, especially if I'm selling it to like a hound dog, like a private equity group. Maybe I'm not selling it to someone who's already in the space. I'm selling it to someone who wants to invest in my market because they think there's potential. And how do I keep as much of that money as possible? So I want to jump right into today's topic and let's start unpacking what's here. So the first thing that I would say is most important from a CPA standpoint is making sure you've got clean financials, right? So what is clean financials? Well, does your bookkeeper just do your transactions as they come through the bank account? Maybe you have 50 or 100 checks clearing your bank account. As they clear, they say, okay, I've got revenue here because it's money coming in and expenses going out. Forget about it. That's typically incorrect, and that is going to make a lot of people watching these videos. It's going to make a lot of your jaws drop because you're like, wait a second, I'm doing accounting. That's not it. So for you to have like clean financials in terms of a private equity group, they have to be on a GAAP basis. GAAP stands for Generally Accepted Accounting Principles. Cash basis is what most business owners do. It's what most business owners think of. It's, hey, I got money coming in, expenses going out, record the revenue, record the expense. But what if I bill someone ahead of time? Let's say I send them an invoice for $100,000, but I haven't actually done that work yet. Well, your bookkeeper's gonna see it and say, hey, we got $100,000 of revenue. And that is wrong, and most people don't realize it. Most people don't realize that whether it be a banker, a business owner, the bookkeeper, even a junior accountant, they're not going to realize that that's incorrect. You don't get to count that as revenue. That's a liability because you have not earned that money yet. And so if you're selling a PE, they're going to have some hound dogs on you. They're going to unpack everything. And that is going to be picked apart, and you are going to lose money on your multiple. You're going to lose money when it comes to whatever your multiple of EBITDA is, because you're counting revenue when it's really a liability. It's money you haven't earned yet, but you're holding on to. So that is the first step of clean financials. They're also going to want to see 2 to 3 years of these GAAP compliant financials. So if you've been doing cash basis of accounting, you have a lot of homework to do. You're going to have to go back and move everything to a GAAP basis and then redo the last 2 or 3 years of accounting. Sounds like a big headache, doesn't it? There are firms out there that can help with that. For instance, a firm like Pillar Advisors, they can basically do projects and say, okay, show us everything. You're going to undergo a financial colonoscopy. I hate to use those words, but they are going to find out everything, and then they will rebuild those financials for you so that you don't have to sweat, so that you can have a clean sale to the PE firm. Every single account on your balance sheet has to be supported by schedules. So if you've got accounts receivables, where are the invoices that tie to your accounts receivable line? If you've got inventory, show me the inventory, show me the schedule. If you've got payables, if you've got loans, show me the latest loan statement, just stuff like that. It gets lost. And then the financial narrative for your business. There can't be any surprises, any undocumented liabilities or handshake agreements. Toss them out the window. If it's not written down, if it's not recorded, it doesn't exist. You're gonna lose money on it because these PE firms, when they're doing their homework, when they're doing their due diligence, they are going to unpack that. They're going to use every trick in the book to drive down the sell price that they're negotiating because they want to get your business for as little as possible, and that's what you're trying to prevent. You have worked your entire life to build this business, and you want to sell it for as much as possible so you can sail off into the sunset and never have to think about work again, right? Okay, so untangling revenue recognition, we kind of already covered that. You have to do an audit of your revenue schedules, make sure that that's accurate. Make sure if you're doing like annual retainers, software subscriptions, make sure you're recognizing it over time. For instance, if someone paid me $120,000 for a contract for 1 year and it's paid up front, I don't get to recognize $120,000 in that month that I received it. It should be recognized at $10,000 a month and spread out because that's how the contract is written. You need to be able to recognize and reconcile revenue against customer contracts, invoicing systems, cash deposits. It's a lot of homework, guys. It really is, and that's why people like me exist. That's why CPAs exist. It's why lawyers exist. It's why firms like Pillar exist, for instance. Because if you don't want to do it, you can say, hey, I'll pay someone else to make this headache go away, and well, that's how I keep food on my table. You need to formally document revenue recognition policies, things like that, so that the buyer, when they're going through your schedules, sees exactly how you implement those. If you're charging fees, if they're usage-based or professional services, how are we recognizing that revenue, right? So, and this is just a profit and loss, guys. We're about to jump into the balance sheet. We lightly covered it a second ago, but I mean, for the balance sheet, like you have to ruthlessly cover your accounts receivable. You have to ruthlessly purge your accounts receivable aging detail, for instance, because if you've got invoices that are over 90 days old, a PE firm is going to say, you're probably not going to collect those. I mean, there has to be a very good reason for them to say, yeah, that's probably legit. If something is aged out 90 days, it needs to be written off. And then if you collect it later, hey, happy, recognize it as revenue, right? Accrued liabilities, things like employee paid time off, vendor invoices, commission payouts. If you are not doing those accruals, which is basically recognizing that expense before the cash leaves the bank account, you're understating your liabilities. And so if you're not keeping up with PTO accruals or employee hours at the end of the year, you know, I'll give you a great example. Let's say Microsoft or Google. When they run payroll, their payroll is probably hundreds of millions of dollars. And so when they do their year-end financials, they need to show what their payroll costs are. However, if they're in the middle of a pay period, they need to show, okay, if I'm 5 of the 14 days through a pay period, there should be 5 days of payroll costs on those year-end financials, because that's money that they owe to their employees that have not yet been paid. Simple stuff like that a business owner's not going to know. A staff accountant's not going to know. Maybe even an experienced bookkeeper is not going to know that. It's just, it's tricky, it's technical, but a PE firm is going to know that, and they're going to cut the amount of money that they pay you down because you don't have these things in place. It's going to shake the reliability of your financial statements, and they're going to say, well, we're just not sure, you're missing things like this. How do we know you're not missing other things? And so that can kill the deal, it can slow the deal down, it can drive down your multiple. I mean, it's just, like I said, you're going to want a firm like Pillar Advisors, for instance, to get in there and make sure that the T's are crossed and the I's are dotted, because this is technical and complex stuff. You're running a business. You're good at selling. You're good at being out in the field. Let someone who's good at the back office help you prep for this and get it ready. Things like add backs, for instance, like we covered the P&L, we covered the balance sheet, add backs. If you've got genuine one-time non-recurring expenses, you can add that back into your EBITDA. If you've got something that's artificially depressing your historical earnings, such as maybe you moved offices, or a lawsuit settlement, or you fired an executive and you had to pay them $10 million, if you can prove that that is a one-off, you can sometimes add that money back in. So just hiring someone, even though it might be $50,000 for them to help you through this deal, if they save you $500,000 and help you get $500,000 more cash, that was $50,000 well spent. Personal expenses, you got to unpack those. You can't have your Taco Bell runs as a lunch expense. It's an owner draw. The business doesn't care what the owner did. That's it. It's going to affect your profitability. Country club memberships, vehicle leases, that is one I see a ton. If you've got a vehicle being paid by your business but used for personal, you really need to pull those out. Do you know how to do that? Do you know how to do the journal entries? Do you know how to actually say, well, actually, this is not a business expense? Do you know how to go back and change those? What about the prior 3 years? Hire someone to do it, guys. Hire someone to do it. It will make your life so much easier, and the cost that you pay them, you will be able to get much, much more for the sale of your business if you just hire someone who is an expert in this to do it for you. Isolating expenses related to discontinued product lines. That's another thing that can affect EBITDA. Abandoned software projects, closed locations, things that aren't going to be a part of the business going forward. Make sure that they're added back. I mean, just things like that. So, and then the final thing, the data hub, the data silos. For my personal business as a CPA firm, we have an accessible drive. You can access it from any laptop or smartphone. But in that, we've got client financials, we've got client work papers, we've got bank statements, we've got onboarding documents, we've got templates. You have to have everything in order to where the buyer of your business says, hey, I need this. Okay, here it is, right there, ready to go. You've got the data. That's so important, because if things start to slow down, they think you're hiding something, or they think you're disorganized, and momentum stalls. They start to question whether or not they've got everything that they're supposed to have, and then the buyer walks away and you're left with $100,000 of legal expense and fees and overhead because you couldn't close a deal, because you didn't have all your contracts, your customer agreements, your MSAs, your real estate leases, your employment contracts. All of this stuff you got to keep up with. It can't just be in a filing cabinet in the attic somewhere. It needs to be accessible, digitized. You need to make sure it's prepped. Detailed employee census data, for instance. You need to make sure that what you say you're paying, what you're paying for, ties to your P&L. Just little things like that. Financial forecasts, historical variances. They've got to be crisp. They've got to be up to date. They have to show that you're using capital efficiently. I mean, guys, the true cost of inadequate preparation cannot be overstated. You could have had a 10x multiple on $1 million net income EBITDA business, 10x multiple, EBITDA being $1 million. Anyway, it's valued at $10 million is what I'm getting at. But if that PE firm comes in and you are just missing the mark on a lot of these, I mean, they could cut you down to 7. You could lose $3 million because you just don't know what you don't know. It's not your job to know that. It's an accountant's job. It's a CPA's job. It's a firm like Pillar Advisor's job to step in and say, hey, we need to make sure everything's bulletproof. The T's are dotted and the I's are crossed, if you will. So overall, guys, clean financials, they're not going to sell the company themselves. They will definitely help change the tone of the entire process, especially if you're prepped and you're prepared. When the books are reconciled, the revenue is clearly stated, the add backs are in, you're getting as much money as you can for the sale of your business. So what you should do is, before the letter of intent is signed, before you get ready to engage with anybody, 6 months before you want to sell, start talking. Start talking to a firm like Pillar. Say, hey, I want to give the keys to someone else. Figure out where you're short. Let them come in, help really solidify everything. Give them 6 months. Clean it up before the pressure starts, and then it's going to just be a much easier process going forward. And so that's how I would advise to do it, guys. Anyway, my name is Jonathan Reich. I'm a CPA. I'm your digital merchant. I'm going to help you trade effort for efficiency. I hope you guys like, comment, subscribe, and I'll see you all on the next video.